Hi, hello, good evening, friends. Warm welcome, one and all, to the Intrazon event, India's largest retail intraday traders online conference. Friends, we are in the 10th session of the entire series, and today we have a very interesting speaker, Mr. Dinesh Nagpal. He has been trading ever since 2006. That's quite a long time, and he runs a company called Blue Chips for You. He's an investor, trader, come trainer, practicing predominantly Ichimoku and harmonic trading techniques. He has more in-depth exposure and expertise in the areas of trading psychology and risk management. And he has arrived today to engage, empower, and educate us with his topic titled Multi-Time Frame Trend Signals Using Ichimoku and Harmonics Trading Patterns for Reversals in Intraday. Sir, on behalf of the entire audience, I extend my warm welcome to you into the program, and thanks so much for accepting our invitation to share your knowledge. And the
Thank you,
stage is all.
Ashok, and thank you for having me out here. Thank you very
Go
much.
ahead, sir. Go
So,
ahead.
so,
Thank you.
so before I start the slide and all that, I would one word for the all the participants who are here and who will be watching it later on, is that we've had some wonderful speakers for the last 9 days, and we'll have more in the next 2 days. My thing would be that don't jump from one study to the other study. Watch one. Oh, this is like this. Oh, I tried this. It's not looking good. This one is looking better. That one is looking like this. This one. So go through all the sessions one by one. Watch them. Then select the ones which you found to be the most comfortable to your kind of trading. Okay, so everyone will be different. Don't listen to what an X, Y, or Z is saying to you. Do this, do that. Everyone will have their own comfort zone. Not saying that X, Y, Z are right or wrong. Okay, so everyone will have their own suitability. Pick that one, maximum two studies, and give it time. Go through it, go through books, go through webinars, go through YouTube channels, go do more and more into it, understand all the aspects of it. Because in 2 hours, to explain to you a particular study and then expect you to do all of it is not absolutely practical all the time. Okay, you need to go into the depth of a study you like. Okay, and then follow it. At least do it for a period of 1 month. Ideally, I would say a quarter, because at least in one quarter, markets go up, down, sideways. So you get to see all kinds of trends. Okay, it's not just one side of the trend, rosy part of the market you will get to see day in, day out. So it will help you, and then you will be able to, actually understand. And why I say this is because it's basic common sense. Today, some of you all may be from a professional background or whatever academics you all have covered and all that. Say, for instance, someone is a doctor, if someone is a lawyer, so they don't start practicing medicine and law straight away, right? It takes a process to do it. You go to the college, you get admitted, you have to qualify, and you study, and then you do internship. You go semester by semester, you go step by step, and then you become, and then you are authorized to practice it, legalize it, and all that. But in trading, you don't need someone else's permission to trade, right? You have your money, you can trade, you can take your margin, you can start doing. Nobody's there to tell you anything for that matter. So take it from that angle, that first learn, first get the whole process inside you, let it develop, and then do. So don't jump. But particularly this is a very big flaw in most retailers. Even I have gone through that jumping from one study to the other. Don't try to be a master in all. It's not, it will never happen. And moreover, if you are going to try to put all the study parameters into the picture, okay, having knowledge in 10 studies, 12 studies is superb, but trying to get a trade using more than two studies, say supposing, or say three studies, you will never get a trade out of it. You might get one trade, two trades, but you will be missing out on 7, 8 trades, or the trade confirmation, if you're going to look at several times of studies, will be very late. So your risk reward will be completely tossed out. Don't do that. Go through all the videos, pick up the ones you like, focus on it, go through it again and again, do a back test, observe it for a week, 10 days, and then start practicing it by trading. Okay, practicing, start with a small quantity, go gradually, step on it, increase as you get better, as you find the flaws, as you find the mistakes you are making, unless you don't are not in line of fire, you don't learn anything properly. Back testing will help you a lot, uh, from the sense, this is good, but unless you do it on your own and do it for at least 1 month, I would ideally say 3 months, but do it for a minimum 1 month before you try another study. So 1 second. So I'll just say a little bit about myself before I start. I'm born and brought up in Kolkata. Family business. We are into imports of steel. I lost my dad at a very young age. I was in school. So once I got into college, my introduction to stock market came when I got into college. So I joined office early, and coincidentally, a lot of people who were doing business with us would be, investors in market. That time the biggest shares were Tisco or Telco, which is today Tata Motor, or Colgate, or Unilever, which is Hindustan Unilever, Hindustan Lever that time, or Ingersoll Rand or Century Text. These are the big stock. People used to talk about investing them, value investing, picking up those stocks and sitting for months and years. And that time, I started with IPOs, that time in 87, started with the IPOs, and then, started buying in cash, holding for a period, selling, some in a loss, some in a profit, continues. Then I got into derivative trading during the Harshad Mehta era. I've even been to the ring in both the Bombay Stock Exchange, and the Calcutta Stock Exchange, the CSE, BSE, as of course as a guest, not as a jobber in the ring. But it was a completely different market then, and that time I was also doing my family business side by side. So trading was a part-time thing, and that time markets used to be only open from 12 noon to 2 p.m. That's it. 2 hours of session. That also, you sit in a broker's office, or you give a landline call to the broker, buy for me this or sell for me that. He would tell the jobber in the ring, and your trade would be done. So imagine how it was then, till how it started happening with the introduction of NSE and automation and terminal and all that. And when now you have apps, you can trade on your own through the apps and all that. So from 2006, till 2006, I saw the Harshad Mehta scam, I saw the dot-com bubble, everything. I saw all those parts, and trading was in out. It was not for a living. It was a part-time income happening, sometimes losses also. From 2006, I took it as a bread and butter. Like, not in my family business, nothing, only trading for a living. So that's what I'm going to run my house. That's how I'm going to build my capital. That's how I'm going to invest everything. So trading, derivatives, FNO, everything. So from there started the journey. And back then, believe me, when you spoke to anybody that what are you doing for a living and all that, I am in trading. So that time the concept was that anyone in the stock market is either a broker or a sub broker, or someone who's an investor by the side. He has some other business, or a retired person with, Warren Buffett type kind of a guy. But trading for a living used to be a shocker. And we were such a small community then, that we used to have this Yahoo Messenger during those days. This is before the WhatsApp era and all that. And we used to chat, and some of them were from a professional, some were leaving and getting on. So I've seen the 2008 subprime also, which was a completely different class, and then all the eras one after the other. And so different eras, different markets teach you different every time. We are constantly learning in this market. We are at every stage. If you think you know a lot, then you don't know anything. You don't know what lies ahead, at the bend. So different, and each correction is different. You can only compare value wise, speed wise, but each correction will have its own way of whacking the top of a lot of people and all that. So a lot of things learned over a period of time. But the most important thing is that from 1987 till 1992 till 2006 and till today, now today, it's the advancement of technical analysis, traders, intraday traders for a living, in positional traders who are doing. It's the advancement, it's the benefit we've had. Most of the studies which we do on which algos are written, or when the non-algo guys do also, are theories of technical analysis written 100, maybe more than 100 years back. Elliott Wave was written in the early 90s, 1900. Even GAN is more than 100 years old. But harmonics is also from market geometry, which goes as back to the pyramids. So these are things which are always there. It was just we didn't have the technology or the data to run it. But today it's across us. It's so easily available. We have web-based softwares. We have phenomenally good softwares to do technical analysis and all that. And the other thing was that even till today, if you talk to your family or your friends or your colleagues or anyone, and you say buy this because it is given a inverse head and shoulder breakout, or say the Dow theory is saying this, or it's an RSI bullish path range and all that, they will look at you with a frown. What rubbish is he talking? Even though your study may be 200% correct. But the same thing when a fundamental analyst from a CA background or an MBA finance background or a cost accountant background says that the cash flow of the company is superb, they are having a phenomenal dividend growth, they are having so much PAT, they have no debt in the company, look at the books, this blah blah blah, it will be taken hook, line and sinker. And maybe he's talking rotten crap and it has already been discounted by the market. But so that's why I have said it for the last decade or so, that the technical team, that the traders who are in the market, we are the Karams of the market, and the fundamental guys are the Arjuns of the market. But both of us do the same thing in the end. So having said that, the other thing is that besides trading for a living and all that, I do train, teach, mentor through my courses on harmonic trading patterns, Ichimoku, multi-time frame signals, and I speak a lot on trading psychology and risk management, which I was just speaking to Ashok some time back. Is that technical analysis or fundamental analysis is heavily overrated. You can outsource it from anyone. Okay. Brokers give you calls, fund managements, reports are available freely on the internet. But what about the part of managing your trades, especially the ones which are not working, where you are in a loss, when you're not accepting stop losses, or when you're in a gain, how your mind is working. See, we as human beings are emotional wrecks. We are not cold-blooded, what do you call, reptiles. We are warm-blooded. Our emotions swing, like a pendulum, from complete ecstasy to absolute disharmony. And I'm sure that most of y'all are also doing it. Even you hear it in social media when the calls are going correct. Mal lao, yippee, cheers and let's go have a drink today. And when the same stock hits a stop loss, all the choices, abusive language comes out, banging out desk and etc. etc. So so how to be a good trader, you need to first understand trading mindset. You need to develop that. And the other part is risk management. How should you manage a portfolio? What kind of an exposure you should be doing to derivative trading? What kind of an exposure you should be doing to intraday trading? What kind of to option trading? And whether you are capable of doing all this. What kind of a capital exposure you have? How much you should be putting in all that in a trade? So these is all the matters which I took. So let's start with the first one. Now, harmonic trading patterns, these patterns have been there from a very long time. So first person to write about it in detail is 𝐻𝐿 So hence we have the 𝐸 pattern, which you all must have heard a lot about. And then there was Bryce Gilmore, who's an authority in market geometry. Now, the entire study, now thanks to advancement in software and all that, almost every charting software, whether web-based or software or computer-based one, has the indicator harmonic trading patterns in it. So now they are used more. Otherwise, you have to heavily depend on the Fibonacci tool to the indicator to do it. So why do markets work like that? So for instance, when we, because see markets never move like this all the way up. So we have a trend which goes like this, then it does a pullback, then it tries to go up, fails to cross this line, and then it does a fall here like this. Okay, so what is this? This is a move from here, this is a high, this is a higher low, but this movement out here which pullback happened, this did not cross this high, so this becomes a lower high now. So this lower high comes and down, joins all the way down here. So in what is that? That is market runs